Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Chief Investment Officer EMEA and Global Head of Equities, and we're going to discuss some of the key themes driving markets. These include President Donald Trump's first 100 days in office, European election developments, and sector rotation in equity markets. So Mark, elections appear to be dominating the headlines at the moment. What have we learned from the UK and the French elections during the last week?
I think we've learned that occasionally the polls can be right. In the UK, for the Conservative Party, a poll lead of about 20% over the Labour Party has proved just an irresistible opportunity for Theresa May to take, and I think wants to get both a mandate for herself, but also more broadly a stronger mandate for the Brexit negotiations that are due to take place imminently. In France, again, the polls suggested that the outcome that we got was indeed the one that we were likely to get. And I think the market's taken some comfort from both of these because in the UK, I think maybe a softer Brexit negotiation has been seen as good for sterling and potentially good for the UK economy. And in France, with Macron so far ahead in the polls for the second round elections, again, the market's taken some comfort for that in that we won't get a non-Euro friendly outcome in the French elections.
And President Donald Trump is about to complete his first 100 days in office. What have we learned from his policies thus far?
What we've learned is that he's failed to get many of those policies implemented, clearly, whether it's the wall, whether it's tax reform, or whether it's some of the other measures. And that's taken the gloss off the market's view in terms of growth going forward. On election, equity markets globally, but particularly led by the US, got tremendously excited about the prospects for structural reform, growth-inducing fiscal measures to be implemented, and went off to the races, led by the cyclical sectors, and so on and so forth. We also saw bond yields rise, and that was good for financials. So a real kind of level of optimism about the future. And as we've had a series of disappointments in those policy measures not getting introduced in the first 100 days, I think we've reined in our expectations for US growth, and that's led to some sector rotation in the underlying markets. So a kind of lot to digest. We got very optimistic, and now we don't feel quite so optimistic.
Shifting the focus to investments, having risen materially, US bond yields have fallen towards the bottom of the recent range. Have expectations for growth stalled?
Yeah, I think that's right. I mean, in conjunction with what we've seen in the US, clearly bond yields we saw sell off from the mid 150s, 160s. 10-year bond yields hit over 260 at the peak as the expectations for growth were accelerating, and also we saw the interest rate rise out of the Federal Reserve. Given Trump's failure to really implement policies, growth forecasts have reined in. Saying that, outside of North America, growth appears to be picking up in Europe. Many of the leading indicators have been accelerating. Company profits have been coming in very nicely, and growth is likely to be higher, not lower in Europe. So on a global level, I don't think our growth expectations have changed, but perhaps the balance has changed away from North America and towards Europe, and that will certainly be helped if indeed we do see Macron elected French president.
And within equity markets, cyclicals have rallied strongly. What are the sector implications of the economic backdrop we're currently seeing?
Yes, that's right. In 2016, as economic growth forecasts accelerated, driven by Trump's election, not least of all, we saw energy prices rise, we saw commodity prices rise, and we saw industrial cyclicals rally very, very hard from the lows, having underperformed quite a lot in 2015. With those growth expectations coming back a bit, with bond yields falling, that's seen a certain rotation in underlying equity markets, potentially away from the more cyclical sectors towards some of the growth stocks, some of the higher return on capital employed stocks, the sorts of things that we generally own. And that's certainly been helpful from our performance perspective. And given current growth projections, we would expect that trend to continue. It's certainly been a more equity-friendly environment for us in 2017 thus far.
Okay, and M&A activity is very buoyant. So do credit investors need to worry given the trends in corporate leverage?
We've seen an extended credit cycle in the global economy. Many companies have taken advantage of low interest rates to issue debt, lever up and buy back their own equity and buy other companies. And it does feel that that is accelerating at the moment. We've seen a larger number of larger deals announced, and certainly debt issuance potentially taking advantage of low interest rates while they're still available has really picked up. And M&A is trading at sort of all-time highs in terms of values and number of transactions. I think credit investors have to pay very close attention to this. The tendency is increasingly for companies to do non-credit friendly deals, and so coverage ratios are coming down, leverage ratios are going up, and I think we have to be careful that if the global economy does start to slow down, if interest rates do start to go up by more than we expect, then that could see some damage done to corporate balance sheets, given the leverage that they're taking on to get these deals done.
Mark, thanks very much.